From our world headquarters in New York on Bloomberg Television, Bloomberg Radio, it is Bloomberg Surveillance. The Dow up 29 points, 9,374. Let's see, the VIX, 26.66. It's improved. That two-year yield, 0.91. It was 0.94 before the... This from Barclays Capital. Michelle, good morning.
Good morning, Tom.
Housing is sort of what you've been writing about recently. We're getting all these positive news about housing. How can you have a housing recovery with a 9.7% unemployment rate?
I think you can. The recovery that we're seeing now in the housing market is just in the very beginning stages. We're seeing an increase in sales from such depressed pace of activity. We're seeing an increase in housing starts, again, from a record low. So it looks good in the sense that you're seeing a shift. But remember, the pace of activity is still really low in the housing market.
Well, Michelle, we did have, the Case-Shiller last week telling us that prices actually went up in, 18 out of 20 metropolitan areas. And the only down ones were Las Vegas. We know that's been a hard hit. And Detroit, which has been in an economic slump all of its own for a couple of years now. So is that telling us the worst is over for housing, or is the worst yet to come?
We think the worst is over for the housing market, absolutely. We think the free fall in home prices has ended. You're seeing a pickup in housing demand. You're seeing a pickup in home construction. We think that you'll probably see, home prices bounce around this level, potentially fall further, especially in some of the areas, as you mentioned, Las Vegas and Detroit. But overall, you are seeing signs that housing is recovering from such a very, very low pace of activity. And in our view, it's consistent with the overall economy emerging from recession and beginning to recover.
And Michelle, I should mention Barclays Capital. Congratulations to your Lawrence Cantor and your entire team taking that fixed income trophy at Institutional Investor. I believe it was a couple days ago. Okay, well, that's fine. And the Barclays view is optimism. Dean Mackey's the most optimistic guy on Wall Street. Great. How can you be optimistic with this mixed but difficult jobs report we just saw?
And that's a fair question, but remember, we're at the beginning stages of a recovery. Typically, you're going to get mixed signals from some indicators, particularly those in the labor market. So a rising unemployment rate is not inconsistent with the idea that the economy is going to see growth in the third quarter. Typically, the unemployment rate does lag.
Yeah, but you're great, Michelle, stop. Your great call is we will see a sustainable and resilient economy into 2010, right? How do you get that resiliency when Ken and I and David Rosenberg are talking about an underemployment rate of 16.8%?
So in our view, we think the unemployment rate is going to peak at 10% and then start to edge lower next year, which, again, is consistent with GDP coming back. In addition, if you look at how many jobs were cut in this recession relative to the amount of output that was lost, there were more jobs cut and the unemployment rate was more than what would typically be implied from the amount of GDP loss. So we think that you can make an argument for the idea that there were too many jobs cut and therefore you have to kind of regain some of those. And even just to get to our forecast for GDP growth, we don't think it's unreasonable that you see 3% growth next year. It's still a fairly modest recovery given how sharp of a downturn we've seen.
Well, Michelle, Tom brought up fixed income and your award from Institutional Investor. Let's talk about fixed income a little bit here. We have 10-year treasuries just under 3.4, and in recent days, we've been getting forecast ranging for the end of the year anywhere from 3%. I think we had somebody even forecast 4.25. I mean, a really wide range here. Where are you guys at Barclays?
We think that you will see rates edge higher, reaching 4.2 by the end of this year, reaching 4.8 by the end of next year. That's for the 10-year rate. And again, that forecast coincides with our idea that we will see positive growth data and we will see the economy continue to recover.
With all of this, Michelle, the mix of it, what are you guys writing about as you go to on Monday morning? Folks, a lot of the Monday notes get crafted Friday afternoon, and of course, Monday's Labor Day. But for Tuesday morning, what's the Barclays theme? What are you talking about as a theme for next week?
Well, we'll see how the data unfolds, but
we're just trying to get a head start on this, Michelle. We're just trying to front run. We're just trying to front run Barclays Capital clients worldwide.
Okay, well, I can't promise what we'll write about next week in advance,
really?
But I think one of the key topics is obviously how strong the consumer is, how strong consumption will be outside this pop we've seen in auto sales, and I think the path of the consumer will really dictate the shape of this recovery. We do need to see core retail sales come back. We need to see consumers willing to spend in order to get a sustained recovery, and that is crucial for our forecast.
Well, and that's a nice way of putting it. The crucial idea of jump-starting consumption, what is the catalyst to do it? Is it government stimulus? Is it business hiring? How do you jump-start consumers out of the lethargy that, not the gloom that Ken and I see in New York City, but the tepid tone out there?
Well, in our view, you need to see the momentum, start to build in the economy. So the stimulus helps in kind of sparking businesses, helping to ignite growth. Businesses will then start to invest and start hiring. Again, the labor market will recover. You'll have support to income. Once you have support to income, consumers can then start spending again. Yes, they will be responding with a lag to this massive wealth destruction they've seen, which will probably restrain some of the upside for consumer spending. But once businesses start investing again, and once hiring picks up, we think that consumers will begin to spend.
Well, Michelle Meyer, thank you so much with Barclays Capital.